Right? So in our last class, last session, I discussed inventories, the closing inventory, cost and NRV adjustment. Right? So we discussed this part and also the trade receivables, bad debt, and provision for doubtful debt. Right? So today I will be discussing the accrual adjustment. Accrual adjustment. Okay. So when it comes to the accrual adjustment, we have to divide it income and expenses. Right? Income and expenses. Then income has two parts. Income has two parts. Income receivable, which is an asset. Income receivable is an asset. Income received in advance, which is a liability. Liability. Right? Then expenses also we divide into two. Expenses payable. Payable is a liability. Prepayment, prepaid expense is an asset. Right? So that's how we divide the accrual adjustment. Accrual adjustment. So I will explain one by one. So you have to carefully listen to this because definitely this will be very useful in all the questions. Right? Okay, so we'll move on to the accrual. So I have taken the accrual adjustment. Write the main heading accrual adjustment. So you can write the main heading as accrual adjustment. Under that, expenses. So I'm going to divide the expenses into two. One is the expenses payable. In another term, we call it accrued expenses. Expenses payable is called accrued expenses. Then we have prepaid expenses. Prepaid expenses is called expenses paid in advance. Expenses paid in advance. Okay, so write the main heading. You can write the main heading accrual adjustment. Under that, expenses. So initially, as the first step, I'm going to discuss accrued expenses or expenses payable. Right. Okay. So let's start with expenses payable. Right. Write the heading expenses payable. Accrued expenses within bracket. Within bracket. Accrued expenses. Okay. Now, if you take an example, let's assume that we are getting the electricity bill of the year or the month, 10,000. We are getting the electricity bill of the business, 10,000. Bill is 10,000 and cash paid, we are paying only 6,000. The total bill is 10,000 and we are paying only 6,000. So the difference 4,000 is electricity payable, which is a liability. Which is a liability, right? And when we are recording these transactions in the account, first we will record the cash paid. Number one, first transaction is the cash payment, right? So before preparing the financial statements, right? When you are preparing the trial balance, you will do the cash paid amount because prime entry will be done. Prime entry books will be done at first. So when you are doing the prime entry books, you will do the cash payment journal. So this is the first transaction that we record. The double entry for this transaction is cash account credit 6,000. So we need a cash account. So we will credit the cash account 6,000 and electricity expense account will be debited 6,000. So two accounts. Cash account will be credited 6,000. Electricity expense account will be debited 6,000. So that will be the first double entry, first entry. Right? So after doing this, you will get the trial balance. Right? So once you get the trial balance, then you have to do the additional information or the adjustment. So this is the adjustment. Electricity payable. This is the second transaction that we need to do. Electricity payable. What is the double entry for electricity payable? Electricity payable double entry is expense account debit, liability account credit. So we increase the expense by 4,000. Say electricity payable. Electricity payable account credit 4,000. This is a liability. Okay. First double entry, cash payment. Cash account credit, electricity expense account debit. The second entry is the payable. So let me write the double entry here. Electricity expense account debit, expense account debit, expense payable account. This is the double entry. Expense account debit, expense payable account credit for the electricity payable. Right? Now cash account, I'm not going to do the balancing part. Now we have the electricity expense. Electricity expense. Expense account will be transferred to income statement under administration expense. Electricity expense. Right? So this difference in this, how much is the total? Total electricity expense is 10,000. So that comes to the income statement 10,000. Electricity expense 10,000 because it is an expense account. Expense account we transfer to income statement, and electricity payable account is a liability account. So this difference will be carried down to the next year. So 4,000 is the balance for forward 4,000. This will be taken to the statement of financial position as electricity payable 4,000. Okay. So when you have electricity paid 6,000 and payable 4,000, in the income statement, you will have the total electricity bill, total electricity expense, right? Whether you paid or not, you will take it under the income statement because income statement is prepared for a specific time period for the year. So you will take the paid amount plus payable amount. And the payable amount will be considered as a liability under current liabilities. Right? Total amount comes to the income statement. The payable amount comes to the statement of financial position. Okay, so that's about the electricity or expenses payable. Expenses payable. So you can copy this note. Right. Next, we have prepaid expenses. Prepaid, paying advance, expenses paid in advance. Now assume that the electricity bill is 10,000. Bill is 10,000. Cash paid, or we are paying more, 13,000. So that's the first thing. Then 3,000 paid extra. So we say prepaid electricity. Prepaid electricity is 3,000. Now how do we record this? First, we will record the cash payment. Cash account credit, 13,000. Electricity expense account debit, 13,000. This is cash. This is electricity. Okay. Now we have the payable, prepaid amount. Prepayment. Now in electricity expense account, there is 13,000. Expense account means that's the amount which goes to income statement. So we can't take 13,000 as the expense because only 10,000 is the expense for the year. So income statement, you should have only 10,000. So additional payment, it should be carried forward to the next year as an asset, right? So payable is a liability, prepayment is an asset. This is a liability. Payable is a liability, prepayment is an asset. Right? So the asset account will be debit, expense account will be credit. Double entry. If we take the double entry, asset account, prepaid, expense account is debit, expense account is credit. Prepaid expense account is debit. Prepaid electricity debit 3000 and the expense account credit 3000. This example, now the balance. How much will be transferred to income statement? Only 10,000. The difference in the electricity expense account 10,000. And the prepaid electricity is 3,000, which is carried on to the next year. 3,000. So administration expense. Expense is 10,000. Prepaid electricity. It comes under current asset. 3,000. Right? So remember, the liability comes under current liabilities. Current, it's a short term. And the assets, prepayment comes under current asset. Current liability, current asset. Right? Expenses payable, prepaid expenses. Under accruals. So you can copy this. Let me know if you are done. Need more time also, tell me. Expenses, payable, and prepayment. Then we are moving to income. Income, we have receivable and received in advance. Right? Remember the terms. I'll repeat again. Expenses payable or accrued expense. Prepaid expense or expenses paid in advance. Prepaid expense or expense paid in advance. I'll give a few more minutes for you to do this. Right. Double entry should be, there's a doubt, double entry should be prepaid expense account debit. Expense account should be credit, not the cash account. Two double entries, right? First entry is, yeah, I have recorded two entries. First entry is this. This is the first double entry. Cash account credit 13,000, expense account debit 13,000. And the second entry is our adjustment. Our adjustment is the prepayment. So the double entry for the prepayment is expense account credit, prepaid electricity debit. This is our double. Prepaid electricity debit because it is an asset. Expense account is credit. Right? In the previous one, this is cash account credit, expense account debit. That's the first double entry. And second double entry, expense account debit, payable account debit. Okay. Right. Now we move to the next part, income. Income receivable is called accrued income. Income receivable is called accrued income. Income received in advance is called income pre-received. So first, let's start with income receivable. Income receivable. And so we'll take an example. Assume that we have a building. So that building is rented out. Rent. And the rent income from giving that on rent income we should receive is 10,000. We should receive the rent income 10,000. Okay. Then cash receipt. We are receiving only 8,000. Total 10,000 is the income, rent income, but we received only 8,000. So 2,000 is called rent receivable or accrued rent. Rent receivable is 2,000. Right? So when recording the transactions in the account, when recording this transaction in the account, first we will record the cash receipt. First we will record the cash receipt. Number one, cash account debit 8,000, rent income account credit 8,000. Rent income and cash. This is the first entry. Now our double entry is the rent receivable. So let me take this format. Receivable 2,000. So receivable is an asset. So double entry is rent receivable account and income account is credit. Rent receivable account debit, rent income account debit. We need to increase the rent income. This is the amount which goes to income statement. Rent income comes under other income. So 8,000 received, another 2,000 is receivable. So this is rent receivable. and that will be debited to the rent receivable account. So rent income. So the second entry, receivable account debit, receivable account debit, rent income account credit. Right? So income account is transferred to the income statement. Receivable account is transferred to the statement of financial position and the current assets. So we take the difference here, 10,000. This is transferred to the income statement. Receivable, we take the balance to the next year. So 2,000. The other income, rent income is 10,000. Current asset, rent receivable is 2,000. Rent income is 10,000. Now look at the initial point. Total income for the year. This is the amount goes to income statement. Total income for the year. This amount. This is the receivable amount. This is taken under current assets. Right? Receivable. SOFP. Now let's take advance. Rent received in advance. So the next example I'm going to take on the rent received in advance. Income pre-received. Income received in advance. Now the rent income is 10,000. Cash received 15,000. Therefore, rent received in advance. That means received for the next year is 5,000. Right? First double entry, we receive cash. Cash account debit, rent income account debit. That's the first entry. 15,000. So in the rent income account, we will have 15,000 cash. But you can't take 15,000 as the income because 5,000 is extra received in advance. So that's a liability. Received in advance is a liability. Therefore, rent income account will be debited 5,000. Received in advance will be credited 5,000. So double entry for advance received. Advance received. Okay. So income statement, we transfer 10,000. Balance carried down that is a liability, 5,000. Rent income is 10,000. Current liability, rent received in advance, 5,000. So this is how you make the adjustment for accruals. So rent received, income received in advance, double entry goes to income account debit. Income received in advance, account income received in advance is credit. Right. So copy this. Okay. Now let's do some examples. Accruals. Do you need more time for this? All right. Income receivable and income received in advance. Okay, so example. Now let's say there is a trial balance. There is a trial balance. So in this trial balance as at 31st March 2019. We have insurance paid, insurance expense, insurance expense 15,000, insurance expense 15,000, right? Trial balance we have insurance 15,000 and We also have rent expense, 20,000 expenses, right? Then we have, right, bank loan, 10% bank, 100,000. 10% bank loan, 100,000. Investments, 200,000. Investment, 200,000. Okay. Then the adjustment, additional information. Additional information, number one. Insurance expense is paid paid from 1st of January 2019 to 31st December 2019. Insurance expense is paid from 1st of January 2019 to 31st December 2019. Okay, number two, monthly rent for the building is 2,000 rupees. Monthly rent for the building is 2,000 rupees. Right. Number three, the bank loan is obtained on the bank loan was obtained on 1st April 2018. First April 2018, and the interest will be paid biannually. Here we will have one more transaction. bank loan interest. Investment, investments was made on 1st October 2018 and investment was made on 1st of 2018 at, at an interest rate of 15% per annum. Okay, so these are the just additional information. So we need the draft financial statements. How much goes to the income statement and how much will be taken to the statement of financial position. Right. So let me draw these two. Current liabilities, current assets. Right. So how much will you take as insurance expense? Rent expense? We take the operational expenses. And bank loan interest. What are the current liabilities and current assets? And also the other income, we have investment income. Investment. So can you complete the income statement and SOFP for this? I'll give 5 minutes for you to do this. After that, I'll explain. Once you are done, you can tell me the amounts. Investment income, insurance expense, rent expense, bank loan interest, and what are the current liabilities and what are the current assets. Right. Shall I explain? Did you all find the answers? Okay. So I will explain the answers for this. Now, first, insurance expense. Number one. Insurance expense is paid from 1st January 2019 to 31st December 2019. Our financial year end is 31st March 2019. So if you draw the timeline, normally it's better to draw a timeline. Financial year starts from 1st of April 2018. Year end is 31st March 19. This is our financial year. Okay. Now, the insurance expense is paid from 1st January to 31st December 19. That means they have paid the insurance for this year. 1st January 19 to 31st December 19. Right? So only this period belongs to our financial year. This is prepaid, paid in advance. Then you need to identify the number of months. So 1st January 19 to 31st March 19, how many months? 1st January to 31st March, 3 months, right? So this year only 3 months, and for next year they have paid 9 months. Then you need to calculate the prepaid amount. Total paid 15,000. What is the prepayment? How much is the prepayment? 15,000 is for 12 months. Divide by 12. Prepayment is 9 months. Okay. So 15,000 into 9 over 12. 15,000 into 9 over 12 is 11,250. Right, so this is the prepayment. Right, so only 3 months, only 3 months belongs to the current financial year. So current financial year means out of 15,000, 3 months. So 3 months means it's 3,750. 3,750. So when you are recording here on the income statement, what you can do is insurance expense. Let me take insurance. 15,000 was paid. Out of this, 11,250 is prepayment. That will be deducted. Prepayment is minus, and it is taken under current asset. Take the current asset out. Prepaid insurance. 11,250. Insurance paid 15,000. Prepayment is 11,250. So that will be deducted from the paid amount. And it's a current asset. Prepayment is an asset. Okay. Right. Then number 2. Number 2 is Rent. Rent expense. Rent expense. Monthly rent for the building is 2000. And here the rent expense paid is 20,000. So let's calculate the total rent. Total rent. Since the dates are not given, we have to pay for 12 months. So 2000 into 12 months. 24,000. So total rent is 24,000. Total rent expense is 24,000, but paid only 20,000. So this need to be increased by 4,000 since we did have to. So rent expense need to be increased. 20,000 paid plus 4,000 payable. So total amount is 24,000. Here it's 3,700. So rent payable is a current liability 4,000. 4,000. Rent is monthly 2000. They have not given a date. Since the date is not given, we have to pay for 1 year because we are preparing the accounts for 1 year, not for 3 months. Our financial year starts from 1st of April 2018 to 31st March 2019. Financial year, if they say 31st, if the trial balance is given for 31st March 2019, year beginning is 1st of April 2018. So we have to pay the rent for 12 months. Rent should be paid for 12 months. Okay. Then next transaction, the bank loan. The bank loan was obtained on 1st of April 2018 and the interest should be paid biannually. So what you have to do is calculate the total interest, 10% bank loan. So if you calculate 10% bank loan interest, 100,000 into 10%. It's for full year, 12 months. So 12 over 12 means it's 1. Okay. Then total interest for the year is 10,000. Total interest is 10,000. And forget about this payment. Payment is not relevant for us. And sometimes they will say paid next year, paid in the 15th of April 2019, or it should be paid before 1st of May 2019. So forget about all this payment. You don't need to worry about the payment. Calculate from the loan obtain date you obtain, right? From the date you obtain the loan to the year end. Calculate the total interest. So here the total interest is 10,000 and see how much is paid. Bank loan interest paid 5,000. Paid 5,000, total 10,000 means payable 5,000. So you need to identify the payable amount. So bank loan interest under expenses, 5,000 is paid, another 5,000 is paid, total 10,000. And it's a current liability, bank loan interest payable, 5,000. Bank loan interest payable is 5,000. And finally, we have the investment. Investment was made on 1st of October 2018 at an interest rate of 15% per annum. Here the investment value is given 200,000. How much is the investment income? We have not received any investment income. Number 4. 200,000 into 15%. Number 4. How much is the investment income? Investment income is 200,000 into 15% into, you have to see how many months. So the year starts, the investment was made on 1st of October 2018. So 1st October 2018 to the year end 31st March 2019. So you need to see how many months. October, November, December, and Feb, March. There is 6 months. So 6 over 12. So 15%, 6 months. 200,000 into 15% into 6 months is 15,000. That's the investment income. 200,000 into 15% into 6 months. 1st of October to 31st March 2019 is 6 months. Okay, so 15,000. And we can record here other income. There is no receipt. Therefore, the total 15,000 is receivable. Investment income receivable is 15,000. Investment income receivable is 15,000. So there was a doubt to explain the bank loan interest again. Now, if I repeat the bank loan interest, bank loan is 100,000, right? And the interest rate is 10%. So you multiply this by 10%. Since the bank loan was obtained at the beginning, 12 months interest should be paid. 12-month interest means 1 year. So 100,000 into 10% is 10,000. Okay. So here bank loan interest paid amount is given in the trial balance. Always remember, in trial balance we have the paid amount. What is the amount we paid? So total interest is 10,000, paid only 5,000. Therefore, income statement you will have 10,000, 5,000 plus paid 5,000 plus payable 5,000. And the payable amount we have to take it under current liabilities. Current liabilities. Is it clear? This is a very important adjustment. Okay. Next, what I'm going to do is a question with this adjustment. I will be doing only the adjustment. I want you all to complete this question and find out the total assets and total liabilities, including the net profit. So I will show how to do the adjustments, only the adjustments. Okay. Right, so let's start the question. KPM Traders is a sole proprietorship owned by Sam Silva. The trial balance of KPM Traders as at 31st March 2019 is given below. So we have the trial balance as at 31st March 2019. Then the additional information, the closing stock valued at cost 1,850,000. So there is no NRV, only the cost is given. Right, so the double entry goes as current asset and cost of sales. I'll give some time for you to draw the format. You draw this format. After that, I will explain the question. Closing stock, current asset and cost of sales. Right. So we will start closing stock, current asset, and cost of sales. We have to record in both. Then we have the depreciation. I'll do the depreciation at last. Bad debt and doubtful debt. Uh, yes, bad debt and doubtful debt. The management decided to write off 100,000 from the trade receivable as bad debt and to make a general provision of 10% for doubtful debt on the remaining trade receivable balances as at 31st March 2019. Right, so we can do this without preparing ledger account as well. Now, if you check the trial balance, there is trade receivable 2,800. Provision for doubtful debt 170. So what I'm going to do is I'll write within bracket here in statement of financial position. Trade receivable 2,800 and provision for doubtful debt 170. These two balances. Okay. Now what they are saying is 100,000 write off as bad debt. So when you write off, trade receivable will reduce. So the net value is 2,700. That's a distribution expense. Bad debt. Bad debt is distribution expense. 100,000. 100,000 write off. And from the remaining, doubtful debt is 10%. 10% means 270. So already 170 is provided. Therefore, another 100 should be provided as doubtful debt. So which is a distribution expense. Doubtful debt under provision. Under provision is 100. Because already 170 is provided. Additionally, you have to provide another 100 only. The net debt balance is 2,430. So that's about the bad debt and doubtful debt. So we did the full explanation in the previous class. Right? Now the third adjustment, we did the closing stock, bad debt and provision for doubtful debt. There is a doubt. So why didn't we do the T account? T account is not compulsory. T account, I explained the full concept, but only the final answer is okay for the answer, right? Because we have shown the plus minuses within bracket in the statement of financial position. So T account is not compulsory. If you want to do it, you can do it. Right? You know the concept. So based on that concept only, we have done this. Okay. So T account is not compulsory. Next. Next is Electricity payable for the month of March 143,000 was not recorded in the books of accounts. So there is an electricity payable. So if you check the trial balance, electricity, there is a paid amount of 1,200. So on administration, we can take electricity within bracket 1,200. Paid amount is 1,200. Payable amount is 143. So you need to add 143 to the electricity account, and it will be a current liability. Electricity payable 143. Electricity expense is 1,343 after the payable addition. Payable amount is 143. Right? So the next adjustment, bank loan. Bank loan adjustment, normally they give like this. Bank loan was obtained on 1st of March 2019 at the annual interest rate of 12% per annum. Year end is 31st March. So this was obtained on 1st of March. So the bank loan is available only for 3 months. That means we have to pay interest only for 3 months, not for the full year. First installment of the loan has been paid on 2nd April 2019. 2nd April means next year. Our financial year end is 31st March. So this was paid 2nd April. So as I said earlier, you don't need to worry about the payment dates. Okay? Because we are preparing the income statement on accrual basis. Interest payable for the year ended 31st March 2019 was not accounted in the books of accounts. Yes, it's 3 months. 3 months interest. So I'll do the working number 1. Bank loan interest. Bank loan interest 3 months comes from, it was obtained on 1st of, oh sorry, how many months? Sorry, it's not 3 months. It was obtained on 1st of March 2019. 1st of March 2019, 31st March 2019. How many months? It's not 3 months. How many months? It's only 1 month. Like I took it as January. Only 1 month. So interest, bank loan interest equals bank loan amount is given in the financial, in the trial balance. Bank loan is 900,000. So bank loan interest need to be calculated for 900,000 into 12%. 900,000 into 12% into 1 month, into 1/12 equals how much? 9,000. Bank loan interest is 9,000. So this is payable, not get paid. Still, this interest is not paid. Finance expense, bank loan interest is 9,000. Current liability, bank loan interest payable 9,000. Double entry, expense account debit, payable account debit. Bank loan interest account debit, bank loan interest payable account debit. 9,000. Next, working number 2. So next I'm going to do the prepaid rates. A similar adjustment I was explaining in the example. Rates paid is relevant for the period 1st January 2019 to 31st December 2019. So if you draw the timeline, our financial year starts from 1st April 2018. Year end is 31st March 2019. And this rate was paid for the year ended 31st December 2019. From 1st of January 2019. Therefore, 9 months prepaid. So how much is the prepayment? Total amount we take from the trial balance. Rates paid is 180. So from 180, 9 months. 9 over 20. 135 is prepaid. Okay, so that will be deducted from the rates. Administration expense, rates 180 minus 135. Only 45 belongs to current year. It is prepaid rates 130. Prepaid rates 135. Administration expense only 45. Because even though we paid 180, 135 is for next year. 9 months is for next year. So only 3 months belongs to current year. Okay, so then we have the depreciation. The policy of the business is to provide depreciation on the straight line basis at cost. 10% building, 20% motor vehicle, 25% equipment. So working number 3, I'm going to do the depreciation. Right. So there are 3 assets. There are 4 non-current assets: land, and building, Total 8,000, land is 3,000. Motor vehicle 2,200, office equipment 1,100. First, let's record them in the statement of financial position. The cost. Land is 3,000. Therefore, building is 5,000. Total 8,000. Total is 8,000. Right? If land is 3,000, building is 5,000. Motor vehicle 2,200. Equipment 1,100. Total 11,300. This is the cost. So once you identify the cost, you need to calculate the depreciation. Land, we don't depreciate, so you can keep the land as 3,000. Building, cost is 5,000. Number one. Building. $5,000 into 10%. Building depreciation is 500. Then number two, motor vehicle. Motor vehicle cost is 2,200. 2,200 into 25%. So 20%. Motor vehicle 20%. 440. See, office equipment. Cost is 1,100 into 25%. 275. So these are the expenses, depreciation expense. So these expenses will be recorded in the income statement. Income statement. Building, motor vehicles, office equipment. So building and equipment comes under office administration. Motor vehicle, we normally take it under distribution expense. Right? Building, depreciation, 500. Office equipment depreciation, 275. Motor vehicle depreciation, 440. So we record the depreciation, annual depreciation. There is no purchases, disposals or anything. So we calculate for the cost given. Building, equipment, motor vehicle. Then we need to see the closing balance, accumulated depreciation. So for the current year depreciation, we need to add this opening accumulated depreciation, 1,200, 400, 225. 1,200, 400, 225. So if you add, you will get the closing balance. So this closing balance goes to the statement of financial position. That's right. you can complete the non-current assets. Okay, so these are the adjustments. Now if you record the remaining, I'll do the rest. Opening stock is 1800. Remaining balances: sales 25,200, purchases 15,500, water 350, trade payables 1900, stationery 150, salaries and wages 1250, bank overdraft is a current liability 1350, bank overdraft interest is a finance expense 110, capital 3295. That's it. So if you balance this, so first let's calculate the profit. Profit is 5078. We couldn't take the non-current liability. There is a bank loan. And 5675. Net profit is 5078, 5,078,000. Total assets and equity liabilities 12,675. Any doubts? So this is preparation of income statement and statement of financial position. Right. So in the next class, I will do the depreciation and especially the EPF ETF adjustment. That's also very important. I will try to do some more areas, and we can focus on the other main chapters. Okay. So any other doubts? So this is our plan. So in the plan, we are here, financial statements, right? The PPE part, I'm planning to do as a extra session, and these are very straightforward questions in the paper. You have direct questions, so we can continue those things. Okay, right. Okay, so we'll conclude the session today. So in the next class, I will do the rest. Okay. So good night and take care. God bless you.